So within this video, we're going to be looking at the private sector, and we're going to be looking at different types of ownership. So the private sector are those types of ownership, those businesses that you often have the objective of maximising profit. Now within this video, we're going to concentrate on just limited companies. So we're going to be looking at two different types of limited companies: LTDs, which are private limited companies, and PLCs, which are public limited companies. Now often students get mixed up between the two, so we're going to be focusing on the main differences between them. But also it's worth remembering that the private sector and the different types of ownership, such as sole traders, partnerships, and limited companies, it's a very common topic that comes up on the Unit 1 paper. There's many questions ranging in marks. You can get the higher marks, look at the different types of ownership an entrepreneur should take. You can look at some of the lower marks, the multiple choice marks. It doesn't matter what type of question you're looking at, it comes up throughout. So the first type of limited company that we're going to consider is the PLCs, the public limited company. And we're going to use Twitter as an example. Because as it says here, a few years ago, Twitter founders Ewan Williams and Jack Dorsey became multi-millionaires overnight when Twitter sold 70 million shares at the US stock market for $26 each. Now, this is a prime example of a company that was probably started off as a private limited company and then decided to go public. And what it means by going public is, I suppose, allowing your shares to be sold on the stock market. So that means any investor with the finances required can purchase shares within whatever stock market they are operating in. So the question is, why would Ewan Williams and Jack Dorsey want to start selling shares publicly when before they did it privately? Now, one of the biggest reasons why companies want to become public is for the sources of finance, the share capital that is available to them. And what I mean by share capital is when investors buy shares, obviously they're buying it for a fee. In this case, it was $26 per share. So for every share that they buy, Twitter will have been acquiring that finance, that share capital, which will help them to further expand their operations. Now, when you go in public and you open it up to the public on the stock market, it really allows them to acquire massive sources of finance to help them to expand. Probably the greatest source of finance in comparison to all other types. Also, when you sell shares to the investors, you could consider the risk and the reward that's involved. Now, as soon as you become a limited company, that is for private and public, and you start to sell shares, then you're actually passing on some of the risk onto the investors. So imagine if you were a sole trader or a partnership, because you have full control of that company, you would have full ownership of the potential risk involved. And that's called unlimited liability. But as soon as you start selling shares, whether that's privately or public, then you're passing on that risk onto the shareholder. So that therefore reduces the risk for you as an owner. So for Ewan Williams and Jack Dorsey, for every share that they sold, they're also passing on potential risk to that investor. And therefore they are benefiting from limited liability. And limited liability, even though it's to do with the risk of failure, it's considered a benefit for owners which are owning a public limited company, because it reduces their risk. Another major benefit of going public is due to the publishing of documents, financial documents, and the fact that you're going on the stock market, it starts to raise awareness of your company. I know Twitter is already a well-known company, but for other companies that are, I suppose, not in as well-known industries, having that exposure on the stock market can create and raise their awareness and possibly even boost their brand image. However, there are also dangers of going public and possible consequences of going public, and again, there is risk. So if we have a look at the dangers of going public and we think again about those financial documents that need to be published, the benefit is it raises awareness, but the dangers, could it be given a competitive advantage? You may have other companies, private limited companies, competing with Twitter, for example, and they might be able to get information on their finances. So their competitors might be able to look at their financial information, have a look at maybe how the company is doing. If the company, for example, is going through any periods of uncertainty, then their stock value might fall, but again, that'll be public knowledge. And if it's public knowledge, then how could competitors maybe react to that? Could they see that as a possibility to maybe invest in marketing to try and place even more pressure onto you as a company? So there is issues sometimes, and there is possible dangers of publishing your documents publicly, but you have to do it, because if you go in public, investors need to see what they're invested in. Also, obviously, as soon as you start selling shares, you do lose some control. Now, in terms of that control, for a public company, it could go to the extreme of a potential takeover. All it would require is for an investor to gain 51% of the shares, and they have technically taken over your company, and you have lost some control of the company, or in fact the majority control, because you are not the majority shareholder anymore. So a massive danger of going public is the loss of control, but also the potential for a takeover. Now, the other type of ownership is a private limited company, which is known as an LTD. Now, a private limited company is different to a public. Obviously, it's private, but what that means is that you invite the investors to invest into your company. So the usual is, who would you invite? Well, people you trust, friends, family. But on a more technical note, you'd probably invite maybe venture capitalists or business angels. What I mean by that is really successful entrepreneurs who want to invest to help your business to grow. They've got maybe contacts, they've got perhaps the knowledge of the market, they've got the finances, they've got the expertise, and they'll really, really help boost your company. So you might want to invite them to kind of help support financially as well as advice. Now, the best examples of a venture capitalist is Dragon's Den. If you think about the program Dragon's Den, all the dragons are the venture capitalists, because they're considering who to invest in. Every contestant that goes onto the show is technically inviting those judges or those dragons to invest into their company. So a good example is Levi Roots, which was a very, very popular episode of Dragon's Den. Levi Roots was an entrepreneur who created his own Caribbean sauce. It was for Jet Chicken, and he had personality. His presentation, I suppose, showed determination. It showed enthusiasm. The taste of the sauce obviously went down well. But what Levi Roots didn't have was the business know-how. He didn't have the financial knowledge. He didn't have the understanding of the supermarket industry. So therefore, he invited the venture capitalists to assist him with this. The venture capitalists, some of the dragons, invested, set him up with the supermarket contacts, improved his financial situation, and helped him to understand his financial records better, because they were inaccurate on the show. And now he's apparently worth more than £30 million, which really shows, by setting up as a private limited company rather than what he was doing as a sole trader on a market stall in London, by setting up as a private limited company and having that venture capitalist who he invited to help him, it massively improves and creates great success for Levi Roots. Other advantages, again, is a good source of finance, as I said before. Not only are they getting financial know-how from venture capitalists, but they're also getting the share capital that's needed to expand and to grow. But again, potential issues comes along with control. And as soon as you sell shares, then you are going to lose some form of control. Now, well, that might mean in decision making, perhaps that, because depending on how many shares that they own, they might want more of a say in decision making. So once upon a time, if you were a sole trader, you, for example, would make the decisions outright, but now you have to discuss it, you have to possibly compromise, and it's not just a straightforward decision anymore.